Okay, well, let's fast forward to 2022, and we have a Meta market cap. I checked this morning of 586 billion, and then maybe if you take out like 50 odd billion of cash, you get to like enterprise value like about 536 billion, and then net income is 40 to 45 billion type of run rate. And then they're spending about 10 billion on Meta. So if you add that back, real net income is like kind of, let's say, 48 to 53 billion kind of number. So it's basically like 10, 11 times net income. I prefer to use net income over EBITDA and all that. But basically 10 or 11 times, one would have never thought we'd get to, on trailing earnings, get to that sort of valuation on a business like Meta. My situation when I look at Facebook is that I see a company that revenue is not going anywhere. Their cash flows are not going anywhere. I think those are pretty solid. I think the user base is pretty solid. So if I were to look at Facebook, I would say that even with 5 or 10% annual growth, which doesn't really seem like a big leap for them to get to, the stock ought to be a double at current interest rates. So I don't have any issue with saying that, Meta in 2 or 3 years is an easy double. I think that's a reasonable bet. The way I would look at it is that Meta is a call option, and that call option from an investor point of view should come for free. And today it is coming for free. So to me, I think if you're an investor looking for a double in 2-3 years, which is really like 25 to 35% annualized returns, which is really good, I think this is a decent bet with relatively low downside. But if you're looking for this to be a 10 bagger or a 5 bagger, I would say then you're getting into speculative land. So just wanted to understand your take on that, Divya.
That was Monish Pabrai on his latest Sum Zero interview. A great interview, by the way. I'll leave a link to it in the description so you can listen to what both of them said throughout the entire video. But he was telling us that Meta or Facebook should be an easy double in the next 2 to 3 years from this price range. And if you didn't know already, Meta has lost almost half of its value year to date already based off some weak Q4 results that it posted and weak Q1 guidance. You've probably seen this already, but it's gone from 350 down to 187 today. Significant drop. For disclosure, Monish Pabrai did say he doesn't own Meta. This wasn't a stock pitch, I don't think, from Monish Pabrai. It was just discussing, obviously, the fundamentals of the business and discussing the latest drop in the stock price and what that means from an investment point of view. And so if we're going to answer the question of is it an easy double, we need to really have context. And let's look at Facebook's fundamentals just to sense check some of this stuff. And so we've got a $510 billion market cap today. If we deduct the excess cash, that's more like $470 billion. If we look at the net income of the business, that's around $40 billion. And I've got here their normalized net income, which essentially is their net income that they reported plus the $10 billion that they're losing, which is committed reinvestments back into their metaverse initiatives. And essentially the normalized earnings is there just to serve as recognition that Facebook's earnings power, real earnings power, underlying earnings power, is higher than it is reported at around 50 billion. So if it thought the metaverse didn't have long-term value and be value accretive to the 10 billion they're spending now, they would not be investing in it. That's what we're sort of warranting there. And so based off those two metrics, we've now got Facebook at 12 times earnings per share and 9.5 times normalized earnings. So a single-digit ratio for normalized earnings for a company that has grown at 37% in 2021 and 33% since 2016 on a 5-6 year trend. We've got forward growth estimates of say 13% from analysts, which make this a 0.9 PEG ratio. In other words, extremely cheap relative to the growth of the business or expected growth of the business. And think about these estimates as being bearish estimates as well. 13% isn't factoring in any resurgence in the growth rate that we saw from the Q4 depressed levels, which is highly likely just a headwind period for Facebook, but that's not a guarantee. And if you didn't think Facebook was cheap already, then I've got some comparable PE ratios here. The S&P 500 PE ratio is 24 times, so double Facebook's multiple that you're having to pay for the earnings of the S&P 500 companies. And really, when you look at that I still think Facebook is a superior company by far than the average S&P company, and its growth potential is higher than the average S&P company. So that's interesting to see. The FANG stocks, which Facebook is a component of as well, so that actually brings the average down, but that's 29 times, and I even wouldn't say in that basket of companies, Facebook is one of the worst stocks in that group. I think they're one of the more superior ones, if anything, in terms of their cash generation, money-making abilities as a business. Tencent, Google, they're very comparable companies. That's why I've put them in there in terms of the customers that they compete for, the services that they offer, and the way that they generate revenue. So again, double Facebook's multiple that you're having to pay for those two companies, 20 and 21 times respectively for those two stocks. So in relative terms or comparable terms, Facebook is very, very cheap. And so now we know that Facebook is fundamentally cheap, comparably cheap, whichever way you want to look at it, Facebook looks very good value. Now let's look at what's needed for Facebook to double in 3 years, just so we can visualize really how possible it is and how low risk it is. It's not like we need anything magical to happen. And doubles in a short time period are usually relying on two fundamental factors. That is outperforming EPS growth or unforeseen EPS growth and a market re-rating. Obviously, the unforeseen EPS growth is usually the catalyst or cause of the market re-rating, and that sort of works as twin engines to spur the stock higher. And so two very possible scenarios here is one, Facebook's growth resurges somewhat, averages say 15% for the next 3 years, and say a 1 PEG ratio, which still would be the market probably punishing Facebook and not giving it a premium valuation, especially when we look at its comparables and considering we're in a pretty depressed environment at the moment. Let's just say it gets back to 15% for the next 3 years or next couple of years and we get a 15 times PE. Hypothetically, that's a 912 billion value for the business, double where it is today. That's one scenario that's very likely. The other scenario is that the market re-rates Facebook once it gets through this period of uncertainty and doubt around the business and the next quarter and starts to look at more of the long-term or even medium-term prospects for Facebook. And it re-rates Facebook the S&P 500 average with flat EPS. So EPS doesn't even need to go anywhere for that. That would get you to 960 billion as a value for the business, which again is a double from here. And I've put these two scenarios in because they're quite easy to visualize and actually see happening, and it could happen all in the space of 2 to 3 years, like Prabrai is saying. And on the topic of being rated as an S&P 500 average company, Facebook back in 2021 was rated at the same multiple as an S&P 500 average company. All right, all it needs to do, we go back to this chart here, to be a double is go back to where investors were buying and selling it at 3 to 4 months ago. And so it's really not hard to visualize, and I just wanted to put that in there to show how possible it really is based off of the fundamentals we've seen and what needs to actually happen as a catalyst for the stock. And I've just got this last point in here as well around buybacks and repurchasing shares. Obviously, we know Facebook does buy back, or has been in the past year, repurchasing quite a lot of shares. I think they've purchased up to 40 billion in 2021 and still have some room left in what was agreed by the board. So Facebook could help this process out of doubling the stock in 2 to 3 years by repurchasing shares at this sort of valuation, at single-digit normalized PEs, right? If we think about what that does for bringing the share count down and boosting EPS at the same time, that could really help the stock achieve its double in 2 to 3 years. And so the investment opportunity is pretty compelling. Just talking in quantitative terms and return profiles here, we've got, if this 2x takes 3 years to occur, that's a 26% annualized return. It says IRR here, but this is actually not accounting for any cash flows or returning cash to shareholders, which they could do, and in quite significant amounts at the current prices. So this is saying a 26% annualized return in 3 years. If it takes 5 years for Facebook to be a double and get back up to where it was 3-4 months ago, that's a 15% annualized return. And then in an extreme case, if it takes 7 years for Facebook to get back up to above $350 per share, again, where it was 3 months ago, that's a 10.5% annualized return, probably better than the market's going to do in that time period. So time arbitrage is key here. It's just showing that even if it takes a very long time for the market to re-rate Facebook, or in another case, Facebook just grows its earnings per share and the rating stays the same, even if it takes 5 to 7 years to do that, you're still going to end up with a decent return. So that is what looks like a low risk, high return opportunity in my eyes. Now, more on the qualitative side, and just looking at the business in a bit more detail, and what screams opportunity to me is you've got this strong cash flow generation that we spoke about in the previous slide in relation to buybacks, which does really provide a bottom for the stock price in the long term. Of course, it could go lower than where it is today, but when you approach a 10 times PE for a quality company like Facebook, where those cash flows are very stable, it does tend to provide a bottom for the stock. And just here I've got Facebook's annual buybacks in 2021, like I said earlier, reached 45 billion. But now with single-digit multiples, management can lower the share count significantly year-on-year, quarter-on-quarter, and boost EPS at the same time, while still retaining earnings in the business. That is what provides a bottom for the stock in the medium to long term. And the next thing, Monish Pabrai actually mentioned in the interview as well, talking about how the cash cow core business, the family of apps, so that's Facebook, Instagram, WhatsApp, Messenger, etc., that producing that 50 billion of net income allows you to wait for the next 2 to 3 years, maybe realize the double that we're looking at here, and then you can assess in 3 to 5 years' time where Facebook are with their metaverse initiatives, because it is relatively unknown what will come of the metaverse, and especially Facebook's investments, that 10 billion each year into the metaverse. Having that cash cow and the current price that you're having to pay for the optionality of the metaverse really allows you to get a free call option on whatever they do in that business, which is pretty compelling. Even if you wait 5 years, like we see from this annualized return, it would make economic sense. The other thing that gets discounted with Facebook a lot is the 3 billion users that they have. 3 billion users in a tech company. That is incredible. It's more than anyone else, any of the FANG M names. So that could unlock significant value within the business if they have a shift to user monetization rather than just user growth like we've seen in the past. And they said it on their latest earnings call. They are shifting this family of apps business into more of a focus on user monetization and how they can unlock value within, say, WhatsApp or Instagram and even Messenger. So that is the reality of Facebook. There's still a lot more they could do within that cash cow family of apps business with the users that they have. And then the last thing really that makes this opportunity compelling, really just rounding it off, is there's a high probability that they will outperform what the market consensus now is. The market consensus for their growth rate dropped significantly after the Q4 results. Again, the market does always think in the short term and think irrationally about what 1 quarter or 2 quarters results mean for the business. I actually think the current price is discounting probably high single-digit growth if you look at where the multiple is and you do a reverse DCF on the company. So that's neglecting any chance of Facebook resurging in their growth that we saw in 2021, or even getting past 10 to 15%. It's neglecting that could happen, which I think is very silly to do. And I think they will reach over 10 to 15% in the next year, and maybe even 3 to 5 years. Now, there's also the potential for a margin expansion, which market consensus doesn't account for. Like we said, the metaverse and Reality Labs is making up 10 billion of losses, and without that reinvestment, we'll call it, back into that business, their net income would be more like 50 billion, which would mean a significant margin increase, and that the stock is even cheaper than we're seeing it today. So both of those things mean that Facebook could quite easily outperform market consensus. And like I've said in previous videos and posts before, if you can find a stock that is going to outperform what the market is expecting from it, the market will reward you with a higher stock price. So that is the rounded investment opportunity that I see with Facebook, both from a quantitative point of view and qualitative. And that's going to be it for this video, guys. I just thought, as we've dived into Meta already on this channel, given what Monish Pabrai had said, I thought was really interesting in the interview that he did on SumZero about how he sees Facebook or Meta as an easy double in the coming years, just because of how cheap that it's got and how good of a business the core business is. And there's sort of a free call option on anything they can do in the metaverse. And I definitely see it being a high reward and a low risk bet. So let me know in the comments what you think of what Monish Pabrai said about Meta, whether you think it can double in the next 2 to 3 years or will double, or is it a stock that is going to struggle for the next few years because of competition and things like that? Let me know in the comments below. I do have valuations on Facebook and Meta, which I showed in the previous video. That is available on the Patreon if you want to go and check that out. You can see, based off various scenarios, what the intrinsic value for Facebook could be and how undervalued it is today. You can also plug in your own assumptions and see how undervalued your estimates make Meta. If you do join the Patreon, you also get access to the monthly deep dive, which was Mercado Libre in January, Spotify in February, and we'll have another one coming shortly in March. You'll also get access to the investing Discord, plus other analysis and my portfolio of stocks and things like that. So check that out if you're interested. Apart from that, guys, leave a like on the video. I will have another video coming out this weekend on another stock that is of interest. So keep an eye out for that. I'll see you in the next one.